strategy is where you sell the physical good, but for that you have to own it, and then you buy it back forward. The cash and carry strategy is profitable if the slope of the curve is very steep, because you buy the good at today's cheap prices and you sell it forward at the forward prices or future prices, but you sell it already today. That's the important thing. You don't wait for the price to go up. You know that you can sell in the future already for a higher price. So these are the two strategies that we looked at, and we'll check a little example in a minute. But before we do this, let's get some okay, let's just get some more technical details. Okay, so instead of doing a cash and carry, you can also do a forward cash and carry. So a cash and carry is I buy spot, I sell at the future. The forward cash and carry is I buy at a close future and I sell at a more distant future. Okay, so that's the difference. I don't use the spot price. I just buy futures that expire at different points in time in the future. So I buy one that expires close, and I sell one that expires further down the road. Here's an example that illustrates that. So you need now 3 periods of time. You need a period of time when you enter all your contracts, and then you have 2 periods of time where basically what you have entered in as contract will take place. So what do we do at time 0? At time 0, we will just buy 1 year future. Okay, again, it's about gold, and we have the futures price for gold expiring in 1 year is 400. Okay, so that's the 1 year futures price. And we have the futures price for gold expiring in 2 years, that's 450. And then we have the forward interest rates. Now we need the forward interest rates because we need to borrow from 1 year to the second year. These forward interest rates are 10%. So the transaction we are going in to lock in is a transaction where we buy the futures, we sell the future in 1 year. We sell the 2 years future, and we enter in a forward rate agreement to borrow the amount that we need to buy the gold in 1 year. We enter a forward rate agreement to buy this at a 10% interest rate. So at time 0, as usual, there's no cash flow, no net cash being exchanged. I just enter in a series of contracts. Of course, I have to deposit a margin in real life, but that I will get back. And then I just wait and see what happens, and I let my contracts roll out. So in 1 year, what will happen? I will have to buy 1 ounce of gold, but I already know at what price I will go. I will buy this. I will buy it at 400, and I can buy it with the money that I have borrowed. Also at date 0 at this interest rate of 10. I didn't borrow, I did enter a forward rate agreement. So again, I wrote a contract that says I will receive a loan with a 10% interest for 1 year in 1 year. So again, the net cash flow in year 1 is 0, because the money I get for this loan is exactly used for the acquisition of the gold. And from that point on, it looks pretty much like the standard cash and carry operation. I will then just wait until the second contract. Okay, so the second contract is a selling contract, so I have to deliver gold. So I will deliver the gold at a price of 450 at the end of the second year. I will I use this money to reimburse the loan, which, remember, had an interest rate of 10%. So I will reimburse 440, and I can keep the difference 10. So what does it prove? It proves that it's not only the difference between the spot and the futures prices that are constrained, if you want, by the cash and carry strategy. Also, the differences between two futures prices are constrained by cash and carry strategies. So if you have a flat curve, but then you have a kink, then you can carry out these kind of strategies. Let me see. I think if I share my, it's a bit complicated here, but if I share my screen directly through, yeah, I think that's too complicated. Okay, but should be able to paint something. Okay, let me see. Just open Paint. This is a bit simplistic, but it's gonna work. Okay, so I think you must see what I do here. This is yes, it seems. Okay, so if you have a futures curve that looks like okay, not very good at painting with my, okay. If you have something like this and then suddenly you have a kink, okay, then you can carry out your, this is not very nice. I need a color and I need a fat trade. Okay. Let me do it again. Okay. So you have a curve that's relatively flat, and then you have a kink, and then it's a flat again. In this case, you can carry out the future cash and carry, forward cash and carry operation around this kink. Okay. And what will happen to the prices? As usual, the cash and carry operation will make it flatter. So we'll go from a steep situation like that to a flatter situation, because remember, you sell the future, so you're putting downward price pressure on that part, and you buy the nearby, so you put upwards price pressure on this part, and that means that this kink should disappear. So that's quite interesting, because I mean, sometimes you have shapes that are obviously not normal, and you can try to arbitrage them away. So for example, here you have a kink. So this is sugar in China. It's one of the few commodities at the moment that are in contango. If you look at sugar in the US, it says world, but that's the US. It's in very steep backwardation. Quite surprising. But sugar in China is in contango. So here you have a kink. You could buy this contract and sell this contract, okay, and then have a forward loan between November 22 and January 23, and with a little bit of chance, the kink will disappear by the time you have arrived, and you need to carry out your cash and carry strategy. Okay, so this is forward cash and carry. Here's the precise explanation, but I think it was clear from the example. And obviously, you can do the same thing in reverse. So you can do a forward reverse cash and carry. It requires, again, that you can borrow the commodity. Okay. So maybe let's go through it, because it's interesting to see how this can work for gold and why this cannot work for other commodities such as cattle that you cannot borrow. So it's the in reverse operation from what we did before. Okay, so we buy futures price for gold expiring in 1 year, and we sell the futures price for gold expiring in 2 years. No, the opposite. Sorry. Okay, so these are the prices. So the 1 year future is 440, the 2 year future is 450, and we have a 10% interest rate. Okay, and then we sell the 1 year future and we buy the 2 year future, and we now have to contract a forward loan, a forward deposit, not a forward loan, because we don't. The reverse cash and carry position will release cash and will provide us with financing. It's like a short position, so we have to invest this somewhere. Okay, as usual, we enter in these contracts at time 0 that doesn't produce any cash flow. At time 1, we need to deliver gold, remember, okay? So the way to do is, in this case, is to borrow gold. And actually, you can do that in the financial markets. There is a gold borrowing rate. So it's actually quite a liquid market. You can borrow gold. And you deliver the gold to the first future, which, remember, expires in 1 year. If you do that, you will get cash, and this cash you invested at the 10% interest rate that you have contracted as well. And then you wait again one other year, a second year. At the end of the life of this futures contract, of the second futures contract, you will take the delivery of the gold from the counterparty. You have bought gold. You will use this gold to reimburse your gold loan, and then you will, let me see, yes, so of course you have to buy this gold that you get delivered, and you will use the interest, the deposit you've invested at the bank, plus the interest to buy this gold. So this deposit plus the interest is 484. We have again a 10% interest rate on 450. So you can use that money to buy the gold, and then you reimburse the gold to the one who has borrowed it to you. And again, this operation theoretically should give you a total cash flow of 35.4. But you can see that it's an interesting, I mean, it's a symmetric operation for financial markets because you can easily borrow and lend the securities, but again, for cattle or for commodities that are in a short supply, it's probably not going to work because you have to be able to, you need the commodity in the same way as for a reverse cash and carry strategy. You need to have the commodity and you need to sell it. Here you need the commodity in the future. Either you have it or, as in this example, you borrow it, but otherwise this operation doesn't work. So what is the conclusion from all of that? The conclusion from all of that is that if it's easy to store and it's easy to borrow and lend a commodity, and the prime example for this is precious metals or gold, then prices will adjust so that these operations will become unprofitable. Otherwise, somebody will take these operations, and that's going to, move price in the direction that makes it unprofitable. Now, mathematically speaking, this is the formula you will get for the relationship between different future prices and actually also the spot and the future price. I think we have the relationship here. Yes. So, I mean, from the cash and carry model, you should get this relationship. Okay. So the futures prices should be simply the spot price plus interest. Okay. For interest, it should be, this is the cost of carry. Okay. And the cost of carry includes storage costs, insurance costs, and financing costs. In the simplest model, in the model that we've just calculated with the gold, there is only the financing costs, but in the real world, you of course have also these other physical costs. For gold, these are mostly negligible. So the futures prices should be the spot price plus these costs of carry. So that was the conclusion from we didn't do that yesterday, we stopped here, but it's pretty obvious that's the conclusion from the standard cost of carry relationships, where we establish a relationship between future and spot prices. And then the forward cash and carry and forward reverse cash and carry strategies, will give us a relationship between two future prices. And again, the difference between these two future prices should be the cost of carry, and the cost of carry again should, so they have these strange rules. Okay. Okay. So the cost of carry includes the financing costs, but also the physical storage costs and potentially transportation costs and things like that. Okay. Now, of course, what you can do is you can look at you can turn the equation around, okay, and you can look at for example, the cost of carry model, and you can calculate what is the implied cost of carry. Okay, so you can just solve this. So you have the relationship between the spot price and the futures price, and we figure out what is the implied cost of carry. Why is this interesting? Because if the implied cost of carry is higher than our own cost of carry, let's suppose we have a very good, I don't know, oil tank or something like that, very cheap for us to store the oil. If the implied cost of carry is cheaper than, is more expensive than our cost of carry, but then we know that we can implement these cost of carry operations. Okay, and if you do that for gold or for financial futures, the implied cost of carry would actually only be the financing rate. So in this case, we can back out the implied repo rates, and we know that if this equation gives an interest rate that is higher than our own repo rate, we can carry out an arbitrage operation. Okay. And that's what I wanted to do briefly with a real life example. So an improvised, I have to warn you, an improvised real life example using Bloomberg. And again, the only commodity that's in contango that I was able to find was actually sugar in China. Actually, most Chinese commodities are still in contango. It's interesting. I suppose that's because they are still buying from Russia, whereas everybody else is not buying from Russia. Okay, so there's shortages for many commodities around the world, but not in China because they still are friends with Russia, apparently, as we've heard yesterday. Anyhow, so let's check what is the implied cost of carry here. Okay, so we need so the curve is upward sloping. I will maybe go to the price table because that's going to be easier to read. No, that's just the past prices. This is not what we want. We want the futures contract table. That's the one we want. Okay, here we go. Here we have the different maturities. Okay, and here we have the different prices. And actually, sugar prices have gone down in China. Well, not a lot. Okay, so let's just look at two contracts with, so we have March 23 and May 22. Okay, so it's not exactly a year, but it's not too bad. Okay, that's the longest time difference we have. These Chinese future contracts don't go very far in the future, apparently. So we have so the idea is, again, we want to simulate the cost of the cash and carry strategy, and we want to figure out what is the cost of storage for sugar that would make a cash and carry strategy profitable. So 5969 is the, okay, I'll use Excel, 5969. 5969. I'm not good at Excel, huh? Yes, 5969. Okay, so that's the March 23 contract. Okay, and then we need the nearby contract, and that's the May 22 contract, and that's 5772. 5772. Okay, and that's May 22. Okay, now what is the increase in the rate? We just calculate the increase in this rate in percentage terms. So, that's not very high. Huh? I thought it was a little higher. Okay, so 3.4% increase over a little less than a year. Okay, so we have to annualize it, of course, to figure out what is the equivalent annual rate. I hope you know to do this. So how do we annualize it? But first we have to add 1. Okay, and then we have how many months? We have 10 months. Okay, but we want 12 months. So we would have exponential 10 over 12, 12 over 10, sorry. Okay. This will give us the equivalent annual rate from a 10 month rate. Okay, so it's 4.1. It's 4.1%. Okay. This is almost exactly the current interest rate in China. So the central bank rate is, I think, 3.7. So if we, this cash and carry strategy will also have, there will be some costs. There will be some, in addition to financing costs. So remember, this is with sugar. So we have to, drive to the warehouse with a lorry, and we have to store the sugar somewhere. There's also a bit of a risk that the sugar will deteriorate if we store it for 1 year. So it's pretty clear that this for sugar here in China, okay, the curve is not steep enough. It looks steep because they cut the scale. Okay, 7. But the curve is not steep enough to make a cash and carry strategy profitable. The slope of the curve is almost exactly the interest rate, and that is a situation where you would normally assume that no cash and carry operation is possible. Okay, so so the implied, I should call it an implied repo rate, implied cost of carry. Okay, it's an implied repo rate if it's a financial security. Okay, so this is cost of carry. Okay, I will upload maybe here. Okay, so let me see. Okay, so again, I'm a little. These slides are a little arbitrary. Okay, so if the implied cost of carry is equal to the actual interest rate, and that's very much the case here in China for sugar, then we would say the commodity is at full carry. Okay, I'm not sure where. Okay. Yes, here, the full carry market. Okay, so if these relationships that we've discussed, okay, the futures price is exactly the spot price plus the cost of carry, and the relationship between two futures prices is also the cost of carry over this over this period, then we call this market to be at full carry. Full carry. And the sugar market in China is, I think, at full carry because the implied cost of carry, if you look at the slope of these prices, is a little higher than the interest rate. This is exactly what you would expect, given that you don't have to pay only for the financing of the sugar, you also have to store the sugar. So it's a pretty well arbitraged market. Okay, now we have to think a little bit. So for the moment, the situation is not so complicated. If we can do cash and carry or reverse cash and carry, if we can store, if you can short sell, then we should see a slope that's simply upward sloping. Okay, this has actually quite interesting implications. Okay, people always think that the slope of this futures curve indicates the direction in which the price is going. Okay, so they always think that if the slope is upward sloping, the prices will increase, and if the slope is downward sloping, prices are going to decrease. But that's not true in case of a commodity that is at full carry. Okay, so actually the shape of the curve doesn't tell you anything about the future price evolution. Okay, what will happen if you have a commodity that is at full carry, and when people think that there is a bigger demand in the future? Okay, so we take gold. Gold is almost always at full carry because it's easy to borrow, it's cheap to store, and it's widely available. So if we take gold, which is a market that's at full carry, and if you think that 1 year from now there will be a huge demand for gold, okay, what will happen? But what will happen is that people will indeed buy gold futures, okay, because they. So I mean, if gold is at the moment, what is gold at the moment? Let's do a real life example. Okay, gold futures. I should have put gold futures. Okay. This is the stock, this is the spot price, okay. Okay, this is a troy ounce, okay. Gold, futures, future. Yeah. Okay, you can see this is at contango. Gold is really almost always at contango. But a very flat contango because this curve has been cut here. Now, what happens if, let's suppose that you think that in December 2025 there's going to be a very high demand for gold, and that actually the December 2025 prices of gold will increase. Okay, but if that's what you think, you should buy future gold in a futures contract on gold expiring at December 2025. Okay, if you buy a future contract on gold expiring in December 2025, you will be able to buy gold at $2,052 per troy ounce, I guess yes, they call it, no, per 100 ounces, okay, whatever, okay. So you will be able to buy the gold at this price, and if you think that the actual price will be higher, you will make a profit, okay. So this is not an arbitrage operation, remember. This is a speculation. If you think that the gold prices are going up in December 25, that's your opinion, and you will indeed make money if you buy gold futures expiring in 1225, but it's not a risk-free profit, and therefore it's not an arbitrage. Okay, but it's of course an investment strategy that a lot of people will carry out. Okay, so what will happen if a lot of people think that the gold price is going to go up in December 25? Indeed, the futures price will go up. Okay, but as the futures price goes up, okay, cash and carry strategies become profitable. Okay, because the slope is becoming steeper. What that means is that not only the futures price will go up, but people will now buy gold and sell it forward, okay? Which means that also all the other prices will go up, and then in particular the spot price will go up, okay? So if you think that there is a higher demand for gold at exactly this point in time, or if a lot of people think that, then indeed the futures price here will go up, but then given these cash and carry operations, the entire curve will follow, okay? So this means that the slope of the curve, okay, the slope of the curve has nothing to do with the fact that the gold price will go up or go down. Any anticipated change in the gold price will actually be, I mean, it will first impact the future prices, but then this will feed through using these cash and carry or reverse cash and carry operations to the entire chain of future prices. So same thing. If you think that let's take another date, that in December 24 everybody will sell gold and the gold price will go down. You will sell gold futures because you want to lock in a high price now. You will sell gold futures. The future price will go down, okay? But then reverse cash and carry. Remember, that's very easy with gold. Reverse cash and carry strategies will set in, and the entire curve will follow. I mean, reverse cash and carry strategies will mean that this part of the curve will go down, and cash and carry strategies will mean that this part of the curve will go down. Okay, and again, any change in the future gold price at a given, any anticipated change at a given point in time will have an impact on the entire shape of the futures curve. Okay, so you will never, okay, even if everybody thinks that the gold prices are going to go down, what will happen is actually that the gold prices will go down immediately. Okay, the spot price will go down immediately. Okay, that's the beauty of this futures model. So in the case of gold, the slope of this curve does not at all reflect the anticipations of a price change. The only thing that it reflects is that is the interest rate, okay, or the cost of carry. So don't be misled into thinking that because this line is upward sloping, that gold prices will increase. There is no information here about what is the likely evolution of the gold price. Okay, if in a commodity that is almost always at perfect cash and carry, I have to insist again on that. The shape of the curve has nothing to do with anticipations. Okay, it doesn't give you any information about where the prices are going. Okay. But of course, for commodities where you cannot do these cash and carry operations, the story is different, and that's what we have to talk about now. What is going to be the shape of the curve in imperfect markets where we cannot carry out these cash and carry operations or reverse cash and carry operations? Okay, so what types of costs will we have? The types of costs you always have are transaction costs. So if you have to pay a fee, for example, to your broker to buy a futures contract, you also have to pay a fee to sell a futures contract. Okay, so these transaction costs, they always work against you, and that means, of course, that you have. I mean, that you have a cost of carry and a cost of reverse cash and carry that always works against you. So here is an example with transaction costs. So again, our old gold example. I mean, let's go over it because I think it's quite illustrative. So here we have transaction costs of 3%. Okay, and we have a situation where previously cash and carry was profitable because the spot and the future price were more apart than the interest rate. You can see that the increase is more than 10%, the interest rate is 10%. Okay, but you can also see that the increase is less than 13%, and therefore probably the cash and carry strategy, including transaction costs, will not be profitable. That's what what we will see here. So indeed, so in this case, we have to borrow the money to buy the gold, but also to pay for the. Remember, we want an arbitrage operation, so they don't want to invest anything, and we want to construct a portfolio that pays out a future cash flow with certainty. So we have to borrow the transaction costs and the amount of money we need to buy the gold. As usual, that has a zero cash flow in time zero. In time zero, but of course we have to borrow more. Then we have our unwrapping operation. Okay, so now the problem is that the loan plus the interest on the transaction costs, okay, will actually be too expensive. So this will exceed the amount of money that we will have made from the stored gold. So in this case, the entire operation becomes unprofitable. Okay, and that's the formula that comes with this. Okay, so of course, only if the spot price is sufficiently small compared to the futures price, multiplied with the cost of carry and the transaction costs, okay, will this operation be profitable. So what happens with reverse cash and carry? Again, it works against you. Okay, again, it works against you. You remember, for reverse cash and carry, you have to own gold. Okay, so you sell the gold, but then you have to pay the transaction cost with the money that you have raised from selling the gold. So here the gold price is 420. So the transaction costs are 12 again, I guess. Yeah, because we have 3% of the amount of money we have raised here. Okay, so now we have less money. We have less money to invest, and once we have earned the interest rate, we cannot reimburse. We cannot use this money to buy back the entire amount of gold. So again, it's gonna be unprofitable. Okay, and what that shows is that actually, okay, this gives you two so-called no arbitrage bounds. Okay, so if the futures curve becomes too steep, even with transaction cost, you can start your cash and carry. If it becomes too flat, even with transaction costs, you can do your reverse cash and carry. But in between, actually, these two no arbitrage bounds, you have a space where you cannot really predict the shape of the curve. Okay, so okay, so here we have the calculation of these no arbitrage bounds. Okay, but it's pretty obvious, I guess. I don't think we have to go over these calculations. Okay, so you have an upper and a lower bound for the future prices in every point in time as a function of the spot prices. But what happens in between these bounds is, for the moment, not obvious. Okay. As soon as the price hits this bound, we will have cash and carry. As soon as it hits this bound, we will have reverse cash and carry, and therefore it's not going to move outside these bands. But again, inside these bands, what is happening, not obvious. Now, turns out that transaction costs are cheaper for example, the floor brokers. Okay, so if you want to trade, of course, you have to pay transaction costs to the broker, but the broker himself, he can trade without paying himself transaction costs. Okay, and that leads to a situation where the prices often, okay, are almost at full carry. So because you are not the marginal decision maker, and the marginal decision maker, the one who pushes the prices, is the broker who pays no transaction costs. Okay. Now you have other factors that lead to exactly the same kind of a difference between, an upper and a lower bound between which you can have this which you can have this futures curve. One factor is unequal borrowing and lending rates. Again, if you have a reverse cash and carry operation, you have to lend, and if you have a cash and carry operation, you have to borrow. So if these rates are different, then again you will open up a difference between the two no arbitrage bounds. This is again calculated here. So it's basically opening up. So you get again two bounds, okay, but these bounds are even stronger than with transaction costs, okay. What else? Restrictions on short selling, okay. This we already mentioned, okay. So short selling means that you have to own the commodity or you have to be able to borrow it, and that's obviously not the case in a lot of markets, okay. And again, if you have these restrictions on short sellings, okay, it's going to open up a difference between the upper and the lower price range that you can have, okay. Now, okay, limitations on storage, same thing. If you have cattle, or if you have milk or cheese, a cash and carry operation is maybe not such a good idea, because again you have to store the commodity, and you have to assume that the commodity, when you sell it again, remains the same as the one that you have stored, and that's also not always possible, okay. Okay, so we've talked about the concept of a full carry market already, okay. So that's the market that can be easily, in which these cash and carry and reverse cash and carry operations can be easily carried out, okay. But most markets are not at full carry, okay. And that means that we actually cannot predict, we can predict upper and lower bounds for the futures prices, but we cannot predict what happens in between, okay. Now, there is one concept that is used. What about now? I think now it works. Okay, great. Thanks. Okay, good. Okay, so where was I? Yes, convenience yield. Okay, I told you that the convenience yield is negative storage costs. How can this be understood? What is a negative storage cost? Now, the negative storage cost is the benefit that you derive from having the commodity in your own warehouse. So who derives benefits from having their own commodity in their own warehouse? For example, if you are industrial producer, you want to be absolutely sure that you have access to your commodity. Okay, so you are valuing the commodity in your own warehouse more than the possibility to buy back the commodity in 1 year, because who knows if this is going to work. Okay, who knows if I will be able to get this commodity in the right moment. In theory, of course, all of this should work, but in practice, you may be worried about, not being able to buy back the same commodity, maybe not the same quality, and maybe it's not being delivered at the time. Maybe we have these problems, that we talked about at the first day with delivery times. So industrial producers, they often like to have the input materials in their own warehouse, and they're willing to to pay a higher price for that, and that's one of the reasons for why we will often see a convenience yield. So and mathematically speaking, it's just a negative storage cost. Okay, they are happy to have the commodities there because they know that they can use it, and they would not sell them to carry out a reverse cash and carry operation. So the convenience yield, again, mathematically speaking, it's very simple. Okay, it's simply a negative. It's a negative cost of carry. Okay, so yes, okay, so I don't know. I mean, this is probably not so relevant for what we do, but I mean, this is just the explanation that we had, the expression we had before. Before we said the futures prices is the spot prices multiplied with 1 plus the cost of carry in percent. And now you can also explain this. You can express this, and this is when you do advanced mathematics on futures prices, you can do it with continuous compounding. I presume that you have learned about continuous compounding. So that means that you can just express the futures price as the spot price multiplied with the exponential of the interest rate and the time. So if the only cost of carry is the interest rate, this is what you would get. If you have storage costs, but then you have exponential interest rates plus, per time storage costs. And then if you have a convenience yield, you get 3 terms. You get the interest rate, you get the storage costs, and you get this benefit that the owner of the commodity derives from having the commodity, which is, again, not so obvious to explain, but which you can actually observe mathematically in the markets. You can see that you need to postulate that there is a convenience yield to make these formulas work. Okay. Now, the takeaway here is, again, that we have, let me try to draw again picture. Okay, so we have our futures curve, and all of these market imperfections will create something like a band. Okay, so if the futures prices are in this area, again, cash and carry. If they are in this area, reverse cash and carry. But within this area, we need another theory, okay, to explain us what is going on. Okay, so within this area, you can have all kinds of quite strange shapes. Actually not totally strange, because our cost of carry cost of carry model also constrains the slopes here. So the slope here should not be too steep, because remember, then we can do forward cost and carry operations. We can we can buy here and sell here. So the the slope, there shouldn't be too much kinks, because these kinks can be arbitraged away as well. Okay, so what is going on in between? Okay, in between these two boundaries, and in particular, okay, why are many markets in backwardation? I mean, normally interest rates and other storage costs would always, increase the slope. Okay, so if you're only considering interest rates and storage costs, then you always have a positive cost of carry, and then you should see an upward sloping curve. But as we have seen in a lot of circumstances, we have actually a downward sloping curve. So if you have a downward sloping curve, it first means that, of course, the lower boundary here is very, very low. Okay, so it means that the lower boundary is something like that. Okay, so that basically we can get a downward sloping curve here. But but even within these boundaries, it's not clear why the curve should be downward sloping for the moment, because all we have done so far is actually explained an upward sloping curve. So unless you assume a very, very high convenience yield, that could explain a downward sloping, so a very negative cost of carry, but that's not realistic. Now, how do futures curve look like typically, and how do they change? So here I've plotted you quite interesting graphs where I hope you can see this. I will maybe blow it up. Where we have the spot curve. No, it's the nearby. So it's not the spot, but it's almost the spot price. So the black line is this nearby contract, and then we have the forward curves. Okay, in different colors here. So that we can see how they look like. And of course, the forward curve, so they start with the close by, and then you have the shape of the curve. So this is coffee, and what you can see is that indeed, in most cases, the curve is upward sloping. Okay, and that is our classic cost of carry model. Okay, the coffee curve is upward sloping, but of course, when coffee prices spike like they do here, okay, it starts to become downward sloping. Okay, and actually, okay, it seems that at this point in time, intuitively, the shape of the curve does indeed predict that the spike is short term, and that the spike will go away. Okay, in this case, the slope, once the market is at cash and carry, okay, the slope here has clearly nothing to do with the future price evolution. Okay, you can see that here the price is going down, but the slope is upward sloping, and here the price is going up, slowly going up. Here it's going down again, but the curve is always upward sloping. Okay, why is that? Because at this point in time, okay, there is enough storage, there is enough possibility to borrow coffee. Okay, you can perfectly easily carry out these cash and carry operations. Okay, what happened here is that we have a massive shortage. Okay, we have a massive shortage, so everybody expects prices to go down. Okay, but actually we cannot carry out. So normally, if you have a downward sloping curve, you should be able to carry out reverse cash and carry operations. But reverse cash and carry operations, of course, imply selling today. And if there is no coffee in the market, because all the coffee is needed by for production, but then these reverse cash and carry operations don't work, and then you can get a very strong downward sloping demand. Okay, so at some moments, okay, in these scarcity moments, the shape is predictive of future prices, but here clearly there's no relationship between the future prices and the shape. Let's look at cattle. My cattle are always a bit complicated. Okay. The message is, I guess, here that it's mostly upward sloping. Okay, but the shapes are always quite complicated. Why are the shapes complicated? Because cattle you don't arbitrage. Okay, you cannot store them at all. So the forces. But I mean, actually what will happen is that future demand really, expectations of future demand influence the shape, okay? And and there's no way to arbitrage away a certain shape, because it's a totally non-storable commodity. And this means, of course, that now the shape of the cattle curves is predictive of what is going to happen to cattle prices. Okay, what do we have here? Wheat. Yeah, quite interesting, huh? Because we have also a spike. Okay, so this is a 2008 spike. Huh? This is a spike, remember, that was exclusively produced by generated by the financial demand. Okay, so this was the financial crisis, and I briefly mentioned this already, 2008, and people were desperate to take the money out of the stock market and find something to put it in. So they put it in commodities such as wheat, and that led to this high wheat price spike. Okay, now what's the difference to the coffee spike we have seen before? The difference is that this coffee spike was, I don't know what happened there, probably a bad harvest or something like that. But so this was not triggered by financial investors. So there was a real scarcity. Here there's no real scarcity. Okay, there's just a lot of financial investors that want to put their money in wheat, and that's why the price goes up. But I mean, these people, they have the wheat in storage. Okay, so as long as everybody's buying, okay, because everybody wants to invest, the curve is indeed downward sloping. Okay, so you don't get these reverse cash and carry operations because nobody's wants to lend out wheat. But then, as soon as the market panic, if you want, calms down, you can see that the reverse cash and carry operations are actually kicking in and producing a very nice full cost of carry upward sloping wheat curve. Okay, so despite the fact that there is this huge price spike, and despite the fact that most market participants will anticipate that the price is going down, you can see these nice upward sloping curves. Again, that's the point is again that the shape of the curve is not predictive of the evolution of the future price, the future evolution of the price, I should say, in case we have this cash and carry, if these cash and carry and reverse cash and carry conditions hold. Only when these don't hold, and that's the case here, then you get a predictive curve. Okay. Now that's what does it mean? So I mean, yeah. What does it mean for the price of what is going on here? There's something missing here. No. Okay, this is what I wanted to. This is what I wanted to have. Okay, I'm sorry, I'm little. The order of the slides is not really what I thought it was. Okay, so what it means is this is what I've been talking about all along. Okay, so if these arbitrage conditions fail, then the other factors have to come in to explain what's going on. And these other factors, but there are two other factors that I would think come in and explain what is the shape of the curve. One is expectations, okay? And that's what we've just seen with these different graphs. As soon as these arbitrage conditions break down, the future price does indeed become predictive of the price evolution in the future. Okay, I mean intuitively. So here we have our two boundaries. Okay, this is something else. We have our two boundaries. Now, if you think that the prices are going to go up in the future, and if the prices are here, you will buy. Okay, so if the expectations are that the prices are going up, then the futures curve will move towards the upper boundary, and of course in the opposite direction if the expectations are that the prices are going down. Okay, so in this sense, okay, where the curve is within these boundaries is determined by the expectations of future price movements. But the boundaries themselves are independent of this expectation of future price movements, again, only determined by these cash and carry relationships. Okay, so that now once you have this gap, you start to have some information about what the future price will be. But that's not all. Okay, we have other factors that will also explain what is going to happen with within these boundaries. And this second factor that has been used a lot to explain the shape of this curve, that's the hedging pressure theory. Okay, so what is this hedging pressure theory? This hedging pressure theory would explain why some commodities are always or almost always in backwardation and others are almost always in contango. What is the idea here? The idea here is that, of course, these future markets are used to ensure either producers or buyers. Okay, and now, okay, so a producer can lock in a price in the future, and a buyer can also. Let's talk about farmers and bakers to make it clear. Okay, so if the farmers can lock in a price for their wheat next year, and the bakers can lock in a price for the wheat next year. Okay, now the question is who. So they both can reduce the risk. Okay, but the question is who is more risk averse. Okay. Who is more risk averse? Because if you have one side of the market that is more risk averse, you will have a higher demand for futures. Let's suppose that we have a market where we have lots of small farmers that have no money at all, okay, and they have to really be sure that they will be able to sell their wheat next year at a fixed price. Okay. On the other side, we have bakers. The bakers are large industrial bakers, and frankly, they have a lot of money, and they really don't care exactly about the wheat price that they will have to pay next year. Okay, so in this case, you will have a lot of farmers that will sell wheat futures. Okay, farmers are selling, so they want to lock in a delivery price, so they will sell wheat futures. Okay, and that means, of course, that the future price will be lower than the expected price in the future. Okay, so in other terms, there's a lot. I mean, the farmers have some idea of what, on average, should be the price at the end of next year. Okay, but the problem is they cannot just wait until the end of next year to sell, because they cannot take the risk that comes with this average. Okay, so instead of waiting and selling on average at a higher price, they are willing to sell a future contract even if the futures price is lower than what they think they will get on average in 1 year. Okay, and that gets you to a situation where the future price is lower than the expected price in the future. Okay, and if you think that on average prices don't move, that gets you to a situation where the market is in backwardation. Okay, so if the hedging pressure comes from the sellers, okay, if the sellers are very risk averse, the sellers will be willing to accept a lower price that they are sure about compared to a higher price that is uncertain. Okay, so you will have a hedging pressure that comes from the sellers. Okay, and the hedging pressure from the sellers will tend to shift the flatten the curve or make it downward sloping. Okay, and in the old times, okay, this is Keynes. Right? Keynes has come up with this theory of normal backwardation. And in the old times, this was a situation. Okay, all these agricultural commodities were produced by many small farmers, and these small farmers, they just had to buy insurance, okay, for their future prices, and they were willing to pay implicitly with a lower price in exchange of being sure about the price at which they are willing, they are able to sell. So in a sense, what you're doing here is when you buy, you sell a future contract, you buy insurance, and you are losing a little bit of money compared to a situation where you just wait, but you're willing to do this because you cannot take the risk. Okay. Now, of course, that hedging pressure can also come from the buyers of the commodity, but that's actually quite rare, but theoretically possible. So if we have, I don't know, a situation where we have one big or several big iron mines or copper mines, let's say copper mines, but then you have lots of very small producers that have to absolutely lock in a copper price. They will buy futures, okay, because they want to be sure what is the price they will pay for copper at the end of the next year. They will buy futures. The copper mine, they are not risk averse. They don't care about locking in a price, okay? So in this case, they will not supply futures, okay? And then you get a situation where the future price goes up, where the future price will be higher than the expected price in the future, because all of these users of copper are willing to pay a higher price if it's a safe price compared to a situation where they just wait until the copper price is realized and they pay at the future price. Okay, so that's the idea. Okay, if you have hedging pressure coming from the suppliers, you get backwardation. If you have hedging pressure coming from the buyers, you get more contango. Okay, and of course, I mean, who buys and sells all these contracts? So I mean, if you have only the farmers that want to insure and the bakeries don't want to insure, you have a lot of future contracts being offered and nobody wants to sell. This is now the social role, if you want, of the speculators. Okay, so they come in, they realize that the futures price is lower than the average future price, okay, and they are willing to basically take this risk from the farmers. Okay, so they buy the future contracts. Okay, the bakeries don't want to buy this, but the speculators are going to buy these future contracts. Okay, so by doing this, they insure a price for the farmers, but they are taking on themselves the risk that, of course, the price at which they have agreed to buy the wheat is going to be lower than the wheat price in the future. Okay, but the speculators have a very useful role here because they are the ones that take on the risk that one or the other side of the market is not willing to take. So they balance the market, they take the risk, and they get a risk premium for it. In the form of expected profits when prices are too low or prices are too high. Okay, and so that's the hedge pressure hypothesis, and this hedge pressure hypothesis leads to this normal backwardation, or potentially also normal contango theory that has been developed by Keynes, which says that in many markets you will have the producers being very risk averse, and these risk averse producers will lead to backwardation. Okay, because if prices on average don't change, then the futures prices will be lower than the current prices, because everybody wants to lock in a future price, and they know that this future price is lower than the expected future price in the future, but they will nevertheless accept a lower price. And that's what you can see here. As I told you, my slides are not very well ordered. So these are the different types of commodities. And here you have the time during which the commodity in question is in backwardation. First of all, we see that, of course, contango is much more frequent than backwardation. But we see that backwardation is extremely rare for well arbitraged commodities where cash and carry operations work, such as precious metals. And it's quite frequent in non-storable commodities such as livestock. Okay, non-storable commodities also that are produced, remember, by a small farmers. Okay, livestock is normally produced by small producers in the US. It's used by very large agriculture. McDonald's. They buy probably millions of cows. Okay, but the producers are still pretty fragmented, so they have to hedge. The big conglomerates that buy the securities don't have to hedge, so that means you get quite often backwardation, and energy also. You get quite often backwardation. I'm not so sure that this is related to the hedging problem, because energy producers are also quite large. This is more about the impossibility of storage and the scarcity. So you have occasionally these moments where commodities are scarce, and then again, like in the case of coffee, here you get these episodes where you have backwardation. Okay, 9:13. I think it's time for a VU Club. Okay, let me open my VU Club. So I think that's the one. Yes, this is the one. We'll give you the address. Go. Show you. Maybe the 0 doesn't show up because I think that's for me. Okay. Here we go. Okay. Oh, very good. Now you can see what happens. That's not good. I thought I had removed this. Okay. Let me exit for the moment and let me, sorry, I have to, results visible. They're not visible. Why are they visible? I don't understand this. Okay. Start again. You're still there. Yeah, so the results shouldn't be visible. Now they're visible. Okay. But you can make up your mind anyhow, so that doesn't really matter. Okay. So if the nearby future is lower than the far out contract, the commodity is what? Okay. Again, a stupid question. Just to see if you're still with me. Nearby, far out. Let me give you a hint. You shouldn't follow your classmates. You shouldn't follow the majority of your classmates. Okay. Okay, 7 out of 8 have replied. Let's stop here. Okay. Nearby, far out. Okay. If nearby is lower than the far out, okay, it means the curve is upward sloping. If the curve is upward sloping, it's in contango. Okay. Backwardation is downward sloping. Contango is upward sloping. It's confusing. There's no good way to remember it. You just have to learn it by heart. Okay. But nearby, far out. Far out is as the name indicates. Huh? So we have an upward sloping curve, and that means contango. Okay, let's move on. Okay, cash and carry involves what? selling the commodity in the spot market and selling the futures contract, buying in the spot market, selling the futures, buying in the spot market, buying the futures contract, buying the commodity. Okay, you can see it. There's four combinations of buying and spot and selling, and it's buying and selling in spot and future markets. Huh? So which one is it? Very good. I've already 15. I think 15 is as good as it gets. Let's see. And now you cannot see the results. Yes, buy the commodity in the spot, sell in the futures. Huh? Again, that's the one. Cash and carry is the standard one where you store the commodity. Okay. Buying the coin in the spot market and selling the futures contract. Actually, okay, you are right. There's twice the same. There's twice the same combination, and they are both correct. Okay, so everybody is correct. Selling the spot market, selling the future. No, that doesn't work. Okay, because I mean you have to sell in one market and buy in the other. Okay. But indeed, there's a mistake here in the WooClub. There's twice the same question. We have the same problem here. The reverse cash and carry. Actually, the reverse cash and carry is not in here because it's twice. Okay, it's twice the cash and carry strategy. I'm sorry about that. There is no reverse cash and carry strategy here. I'm gonna block you. Okay, I'm gonna block you right away. Otherwise, you're going to make a mistake. The reverse cash and carry strategy means selling the commodity in the spot market and buying the futures contract. Huh? But that's not here. Okay, so there is no cash and carry strategy here. I should have checked my WooClubs. This was from last year, but apparently I made some mistakes last year. Okay, so remember, selling, it's the opposite of the cash and carry. Cash and carry is buying the commodity in the spot market, selling the future. So reverse cash and carry is selling in the spot market and buying in the future. If you own the commodity and implement a reverse cash and carry strategy, you have to pay the storage cost, or you can save on the storage costs. Okay, so you are, I don't know, a bakery and you have a lot of wheat that you don't need at the moment, so you decide to, the curve is downward sloping, you decide to sell it now and buy it back later. In this case, you can save the physical storage costs, okay? Because you're selling your commodity, so you don't pay the storage costs anymore, and you buy it back later on. So you can save. One of the components of the reverse cash and carry strategy is that you're getting rid of your storage costs. You're getting rid of your physical storage costs, and you're also getting rid of your financing costs, because you sell the commodity and therefore you can invest the money at an interest rate. So you derive benefits from the reverse cash and carry strategy. The cash and carry strategy is expensive because you have to finance the commodity that you buy, and you have to find a place to store it. In the reverse cash and carry strategy, it's the opposite. Also, a commodity that is at full carry will be in backwardation or in contango. Now the replies are coming in slowly only. Okay, full carry means that all of these arbitrage operations are arbitraged away. So we have a shape that makes it impossible to do cash and carry and reverse and cash and carry strategies. Okay. Then the answer is contango. Yes, because you have to pay the interest rate, you have to pay the storage costs, and that is normally leading to an upward sloping curve. Okay, only if I mean, you can reason in cash and carry or reverse cash and carry, but it's obvious that the cash and carry strategy is only profitable if the futures price is higher than the spot price, because again, we have to finance the acquisition of the commodity today, and then we have to store it for the entire period. Okay, so the correct reply is contango, and that's the reason for why normally commodities are in contango. The majority of the time, most of the time, commodities are in contango. What is happening with higher interest rate? Would that lead to stronger contango or stronger backwardation? So to a higher slope or to a lower slope? (15) Higher interest rates will lead to stronger contango. Guys, you have to up in your game a little bit. Interest rates, okay, make it more expensive, okay, to carry out the cash and carry strategy. So that means you have a steeper slope. I mean, maybe some of you could explain the reasoning for that, but and I could try to explain why you are wrong. Okay, but let's finish this first, and then we. Okay, a commodity that can be easily stored and sold short. So commodity that for which normally the cash and that is as at cash and full cash and carry. So an upward sloping futures curve implies that spot prices will increase. An upward sloping future contains no information about the evolution of the spot price. Okay, so I briefly discussed whether the shape of the curve tells you something about where the prices are going. And we said sometimes it does and sometimes it doesn't. And it really depends on the type of commodity, and it also depends on whether there's scarcity or not. But let's suppose that there is no scarcity and that you have easy storability. What does it mean about the prices? Let's move on. Still have some questions. No, okay. The upward sloping curve means contains no information. Okay, so that's what I tried to explain when we looked at these graphs here. Okay, for example, here the wheat. Okay, the wheat is upward sloping. The wheat is upward sloping because the cash and carry relationships hold, but everybody expects the prices to go down, and actually prices are going down very quickly, because the anticipation of future price decrease feeds through to the current price. Okay, so in case there is easy storability, and in case there is it's easy to sell short, means that there is no information. The shape is only determined by the cash and carry relationships. Okay, the shape has nothing to do with where the prices are going. Okay, in case these cash and carry relationships are possible, again, if let me maybe do our graph again. Okay, if we have a commodity for which cash and carry relationships shouldn't be yellow, are efficient, work well, so you will have basically, okay, very narrow upper and lower arbitrage bounds. Okay, so you have very small transaction costs, of course, but you know that whatever happens, the futures curve will be within these bounds. Okay, and these bounds are always upward sloping. Okay, so the upper one is always upward sloping, and the lower one is also upward sloping. It's the lower one comes from the reverse cash and carry. It's always upward sloping because you save on the transportation costs and you make financing costs. Think about it. Okay, so if you have a situation where a cash and carry is possible, you will always get an upward sloping curve, even if you think that future prices are going down. Actually, if everybody thinks that future prices are going down, then the entire curve will move downwards. Okay, but the shape of the curve will not change. Okay, if you have a situation where these constraints don't work, okay, then it looks like that. Okay, and then indeed, okay, if everybody thinks that prices are going to go up, and you will see something like that. Okay, and if everybody thinks that prices are going to go down, then you will see something like that. Okay, but again, that's only the case. This large gap here between these arbitrage operations, okay, this only happens if there is no way to store the commodity and if there is no way to short sell the commodity. Otherwise, this lower bound will move up and basically constrain, okay, the shapes of the curve. That should have been red. Have something like that. So the big, this is, no, I shouldn't try to write here. Okay, this one is no arbitrage, no storability. This one is arbitrage and storability, short selling and storability. Okay, let's move on. Time is it? Almost break time, so let's do the last two questions. Okay, if a commodity cannot be easily stored and sold short, the upward sloping future contains no information, implies that spot prices are expected to. A downward sloping future price normally implies spot prices to decrease. Okay, so that's basically what I just said. So now we cannot store and we cannot sell short. So we have a large gap in these upper and lower boundaries. And within these gaps, we will have actually, okay. This is equally, okay, no, the correct answer is the one. Okay, now we have the expectations that enter the shape. Okay, because now the shape is not constrained anymore by these no arbitrage relationships. Okay, I think some of you have to ask some questions after the break, because you're clearly a bit confused here. If producers of a difficult to store commodity are very risk averse and buyers are risk neutral, the commodity will be in what? Contango or backwardation. Producers are risk averse, buyers are risk neutral. This is the hedging hypothesis. Okay, contango or backwardation. Shall we try to get to 15 for this one? You seem to be more responsive here. 15. Another one. Yes. Okay. Oh. Okay. So we have hedging pressure from the sellers. Okay. We have hedging pressures from the sellers, and that means that we will end up in backwardation. Okay. Because the sellers want to lock in prices, so the sellers are selling a lot of future contracts, and that means that the price of the future contracts will go down, and it can go down compared to spot contract and can go down compared to the expected price in the future. Okay, let's see who the winner is. Let's see who the top 10 winners are. Very good. 1 gold medalist and 3 silver medalists. Okay, Congratulations. Okay. It's going to be part of your participation grade. Okay. Good. I guess the time for a short break has come. Okay. So, okay. Yeah, apparently, so I missed, okay, the zero. I don't know why. I have a zero probably as the administrator. Huh? So, yeah. Okay. Let's have a short break and come back at in a half an hour. Okay. So, at 10 o'clock for me. Okay. Uh, and I don't know what time for your break. Break. Okay. So see you in 25 minutes now, huh? Something like that. Okay, let's start again. So we move to the next slide set. We move to chapter 4, and we will start to figure out what kind of trading strategies can we implement to try to benefit from changes in commodity prices. Okay. And in particular, we will talk about these inter-commodity spreads, and the so-called crush spreads. Okay. So these are different ways to benefit from anticipated changes in the futures curve, or to benefit from certain relationships between different commodities and future prices and real prices. Okay. Now, the first part here is just a reminder of what we just said. So the cost of carry model implies a range of possible prices, and within these bounds, but these prices are normally upward sloping, at least if the cost and carry, if there's not a lot of transaction and storage costs, but within these bounds, the future prices are determined by expectations of the prices in the future, so future spot prices, the convenience yield, transaction costs always, and hedging pressure. Actually, transaction cost is more about the boundaries of these cash and carry restrictions rather than what happens inside. Okay. Now, we've already looked at different types of commodities, and we can actually sort them as a function of their storability and availability. And as you will see, the precious metals are on one end of this scale, so very easy to store and widely available. And then on the other end of this scale, you have the livestock, live cattle, where they are very impossible to store and they are not easily available. Okay, so if you don't have cattle produced, then you cannot just borrow them from somewhere. That's not the case for gold. You have hundreds of tons of golds in the cellars of most banks, so it's very easy to borrow this. And the other commodities here are somewhere in between. Some are easy to store, copper, lumber, oil, but not always available, because these are industrial metals and sometimes there's a scarcity, though you need, for production, you need more than what you have at the moment. And then you have the other types of commodities, such as pork bellies, which are widely available. There's always frozen pork bellies, but the storability is limited, because if you even if it's frozen pork bellies, after a couple of years, then you don't want to eat them anymore. So okay, so these characteristics will define how often these different commodities are in contango or backwardation, and how much information you have about the price in the future from looking at the futures price. Okay, precious metals, basically basically always at full carry, no information about the future price in the shape of the curve. Livestock, basically never at full carry, and therefore a lot of information about what the prices are going to do in the form of the futures curve. Okay. Now let's all of this is pretty obvious, so let's just jump right away. And this is basically something we've already done. So the implied cost of carry, which will tell you, you compare this implied cost of carry with your real cost of storage and financing, and you will be able to figure out whether cash and carry operations are profitable. Okay, so let's right away look into the trading strategies that we can implement. Okay, so normally traders in the commodity markets do not directly place a bet on changes in prices. Okay, so you don't take a directional bet on prices going up or prices going down. You try, because that's much too risky. You try to, and it would require a lot of margins, remember. So instead of doing that, you're trying to combine the positions so that your risk is lower, and that you can more precisely, you can be more sure about what is going to happen to the futures curve. So if you are taking a direct directional bet on the change of a certain future price, you people talk about an outright position. Okay, so an outright position is directly I buy sugar for delivery in September 22. Okay, 2 contracts of sugar. Okay, that's an outright position, but as I said, this is very rare. Normally, traders will have more complicated and less risky positions, and these positions are typically called spread positions. And we have already talked about the spread, the intra-commodity spread and the inter-commodity spread. So what are spread positions? Spread positions are positions where you combine a long position in a futures contract with a short position. So you buy futures and you sell futures, and you either buy and sell futures on the same commodity but with different dates. Okay, and that's called an intra-commodity spread. Okay, or a calendar spread because of the different dates, or you do it with across different commodities, and then it's called an inter-commodity spread. Okay, but normally that's the type of positions that you will take. Okay, so for example, this allows you to place bets on the shape of the future curve. Okay, so this is the old example I had last year, but we can basically look at Bloomberg and try to look at what kind of contracts could we lock in. Let's look at sugar in the world. Okay, so this is a sugar future, and it's a strongly downwards sloping. It's strong backwardation. Okay, and it's also a pretty strange shape. Okay, you can see that it has lots of kinks. Okay, so it would be likely. I mean, this is a storable commodity. Sugar is storable. It's probably not cheap to store it because you have to supervise it, and probably you need dry air or whatever, but it's not so complicated. So it's a storable commodity. It's a commodity that is normally not in limited supply. Apparently here in the world it's in limited supply. I don't exactly know what is going on, but we would have to read the specialized press to see why the spot price in sugar has apparently increased quite a bit. Let's check what's going on with sugar in the long run. Okay, so this is the 6 months, 1 year, and 5 years. Okay, so yeah, so that's what I guessed. Okay, so the sugar prices have increased quite a bit, and you can see that this is a much more normal shape. This is a much more normal shape. This is what we had 5 years ago. Okay, this is a flat shape. It's still a little bit, I mean, there's some kinks here, but I mean, these kinks are between the price of 17 and 18, so it's probably difficult to arbitrage it away. But that slow, strongly declining shape, I would think, is highly unusual. So we can try to place a bet now on the shape going from that form back towards this form. Okay, so we can place a bet on a flattening shape. What would we need to do to benefit from a flattening shape, but not suffer if sugar prices go up or down? Okay, but we can do this with an intra commodity or calendar spread. Okay. Yeah, I was trying to go to ask you this question. Okay, maybe somebody can answer. Okay, maybe you can answer why. How can we benefit? Okay, what should we do if we are convinced that this very strong backwardation is not going to last, and we will go more back towards the kind of shape that we had 5 years ago? What should we do? What kind of calendar spread should we implement? How can we benefit from flattening? Okay, I will try to remove this. Probably not. Pretty tough to communicate with you, huh? Okay, so I'll probably have to answer this question myself, as most of my questions. So, if we place a bet on the flattening of the curve, we would think that the nearby contracts, these ones, decrease, and the far out contracts increase. Okay, so what we should do, of course, is we should take a position where we benefit from both. Okay, which means what? It means short the nearby and long the far out. Okay, short nearby, long far out. Okay, that is a calendar spread that should only increase our increase in value if the curve becomes flatter. Okay, what will happen if sugar prices go up across the curve? Okay, we have seen that most of the time actually the curve is going to move in parallel up and down. The basis, remember, tends to be relatively constant, meaning the difference between the spot prices and these future prices is more constant than the overall level. Okay, we can see that, for example, here since 21, the shape has relatively remained the same, but the prices have gone up. So in this case, the basis has remained more or less constant, and we can see that actually since last. No, this is 6 months ago. Let's do another one. Okay. Actually, the shape has already flattened a little bit. Okay. Now we want to place a bet on the shape going back there. Okay. So we have a short position here and we have a long position here. Okay. What happens if the price goes up in parallel? If the price goes up in parallel, we just break even. Okay. We make losses on, if the price goes up, we make losses on this short position in the nearby, and we make profits on the long position in the far out. But if the movement in prices is parallel, then these two, the losses and the profits will exactly set off, cancel out each other. So we will be perfectly hedged. And we will only make money if the slope of the curve becomes flatter. Of course, we will lose money if the slope of the curve becomes steeper. Okay, but I mean that you cannot have a bet where you always win. But frankly, I think it would be a good trading strategy here. Okay, to place a bet on a flattening curve, given that in China, the curve is upward sloping, and given that we know that the markets are normally not in backwardation, okay, unless we have a situation where we have a lot of hedgers, a lot of companies that want to hedge, but 80% of the time markets are in contango. So here we have a situation where the market is in backwardation, and I think there's a high likelihood that the market is going to go back into contango. So I think there's a high likelihood that we can, place a winning bet on simply the curve flattening. I'm not sure that you can do this as a retail trader, but it looks like a good strategy. Okay. So this is what I'm doing here. So I'm doing it here for the rubber contract. Okay, but it's the same kind of idea. So if I have a calendar spread, it's not going to affect my overall profits if prices go up or down, but it's going to depend on the changes in the slopes, and the change of the slope seems not so complicated to forecast here, and at least given that in the long run we would expect the slope go back. It has been negative for quite some time. I mean, we would have to find out exactly why it is negative. Again, this is presumably related to scarcity at the moment. So apparently everybody thinks that production is going to go up in the future. So here we have anticipations of future price declines that are integrated in the price, because reverse cash and carry operations clearly don't work here. But otherwise we would see an upward sloping curve. But we can still place bets on the flattening of the curve. Okay, so that's a simple intra-commodity or calendar spread. Now, the traders, they distinguish between bull and bear intra-commodity spreads. Okay, so a bull spread is it turns out that typically price changes are also related to slope changes. Okay, so if you have a full carry market, if the commodity increases in price, the distant future price increases more than the nearby futures price. Okay, so if you have an increase, you have an increase that also comes with a change in the slope. Okay. And if you have a non-full carry market, then the opposite happens. So if you have full carry market, so the future price is simply linked to the spot price by the interest rate, and it's obvious that if you increase the price, then the futures price will move more because you get an interest on a higher value. Okay, in non-full carry markets, remember, the price is more influenced by expectations or by anticipations of future price changes. In this case, what you can often have is you will have fluctuations of the short-term price, because there is a short-term scarcity, and this cannot be solved by reverse cash and carry strategies. So you have a short-term scarcity, but everybody expects that this short-term scarcity is going to go away. Okay, which means that the long-term prices will be relatively stable, but the short-term prices will fluctuate. Okay, so in this case, you can have an increase in the short-term prices. Okay, but actually, this increase in the short-term price will lead to a flattening of the curve. Okay, so the traders know that. Okay. So that price changes, normally come also with a slope change, with a small slope change, and therefore they talk about bull spreads and bear spreads, So a bull spread is of course a spread that a bull and bear. A bull means prices go up. Bear means prices go down. So bull spread is a spread that would go up in value because when prices go up, and bear spread is the one that increases in value if prices go down. But it actually depends on what commodity we are talking about. So if we talk about precious metals, if you have we are in the first case here, so we are in a full carry market, and this means that normally the prices, if prices increase, the slope increases, and if prices decrease, the slope decreases. Now, if you short the nearby and you have a long position in the distant, okay, if prices go up, okay, if they go up in parallel, you are hedged here, of course, okay. But normally in this case, if prices go up, they go up more in the long, okay. So it means that you're making money if you have this short nearby and long distance position, okay. If prices go up, if they only go up in parallel, you don't make money, okay. But normally the price increase is combined with an increase in the slope for this, okay, full carry market, which means that typically you make money from this position, okay, from this spread position if prices go up, and you lose money if prices go up from this position, but you will of course make money, okay, if prices go down, okay. So if you have a full carry market, then a bull spread is a short nearby and a long distance, okay, and a bear spread is a long nearby and a short distance, okay. Now if you have non-full carry market, as we said, okay, the situation is inversed, okay. So price increase is normally the short-term prices change more than the long-term prices, okay. So a price increase is normally related to a flattening of the curve, and the price decrease is related to a steepening, and that means that the position that typically increases in value if prices increase is the opposite to the position that increases in value if prices increase in the full carry markets, okay. It's a bit there's lots of symmetries here, but I think you got the idea, okay. So if you have a bull spread, it's a spread position that depends also on the absolute values, because normally the level changes are related to slope changes, but the one that makes money and the one that loses money depends on if prices go up, depends on what kind of market you are in, okay. So these are just trader expressions, bull spreads and bear spreads, but you have to know that a bull spread in precious metals is actually the opposite from a bull spread in for example wheat, okay. Now you can also have so-called butterfly calendar spread, okay. A butterfly, avoid the indirect exposure. A butterfly calendar spread is neutral to this bull and bear spread effect, okay. A butterfly calendar spread actually is a way to place a bet on the curvature of the curve, okay. So if you think that, so let me try to get some examples, okay. So if I look at this thing here, okay, let me remove the historical prices. Gets a little bit complicated to read, but if I look at the sugar market here again, I would think that here we have something strange going on, okay. So I think that this one is too high compared to this one and this one, okay. Why is there this strange kink, okay? It should go away. It should go away in the long run, okay? Now, how can we make money from the disappearance of this kink? It's again pretty obvious, okay? You have to place a bet on this value declining, and you have to place a bet on this and this value increasing, okay? Which means that of course, then this means that you have to buy 2 contracts here and you have to sell 2 contracts here, okay. And that's exactly that, so if we have now this is the opposite bet, okay. So if we want to place a bet on the fact that this kink is gonna go away, okay, we have to have a long position of the nearby and the far out, and we have to have a short position in the intermediary, okay, in that so that would be the situation in the brackets here, okay. And in this case, you are almost perfectly hedged against the price increase. You don't even have this indirect effect, which comes because the slope of the curve will often change together with the absolute price level. So Here we have a calculated example. Maybe let's have a calculated example because I think I'm talking theory here. So it makes sense, I guess, to have a calculated example. So let's look at the butterfly spread. Okay, so we have copper futures and we have a kink in the shape of the curve. Okay, so we can see that the July, September, and December. So these are the three contracts. Okay, you can see the July and September contract are always the same price, and then suddenly the December contract is much higher. Okay, and that is strange. Okay, that seems like a situation that should not last. So we would place a bet on the fact that this kink here is gonna go away. Okay, now how we do this? Again, we have to implement a butterfly spread. So we will have we would think that these ones should decline compared to this one. Okay, so we have to have a short position on the July and on the December contract, and we need a long position on the September contract. Yes. Okay, so that's what happens here. Okay, so short position on the July contract, short position on the December contract at the prices, and then we have, because we have two short positions, we have to offset this with two long positions. So we buy two long September contracts at 67.5 cents per pound. Okay. Now what happens if so this we do it on November, okay, the year before. Okay, now if until April the kink has disappeared, okay, what is happening here? Okay, if the kink has disappeared, what we will do is we will simply offset our contracts and exit the position. Okay, remember that offsetting the contract means buying a contract with the opposite direction and then bringing it to the clearinghouse and saying, okay, here I'm done. Okay, so now we have to buy one July contract, we have to buy one December contract, and we have to sell two September contracts. Okay, we are not at expiry yet. Now, what are the prices? The prices. What happened here? Indeed, if you compare these prices to these prices, you can see that the kink has disappeared. Okay, so actually the July contract has decreased in value. The September contract has almost remained the same, and the December contract has also decreased in value, but by much less than the July contract. Okay, so now we have a more regular increase of the future prices over time, and that's what we would have expected. Now, what was happening with our different positions? Okay, let's first look at the profit we made on the July contract. Okay, so we have a short position. Okay, so it went down from 67 to 65. So we make 3 cents per. We have a price change of 3 cents. Okay, no, 2 cents. Sorry. Okay, so one copper contract is. So this is again, the prices are quoted in cents per pound. Okay, and this is an old example. I don't think you can buy copper at this price anymore. And a contract is for 25,000 pounds. Okay, so this means that a 2 cent change over this time multiplied with these 25,000 pounds leads to a $500 win. Okay, so we make $500 on that position. Okay, now what happens to the September position? The September position, we thought that it would rather go up, okay, because we thought it was too low compared to this one, but actually it didn't go up, it went down. Okay, but this is not a big problem because actually the other ones went down as well. So you have the entire shape that went a little bit down. Okay, but actually when going down, so there was this kink, and when going down, the kink disappeared. Okay, so we have half a cent of losses. Okay, so it went down and we had a long contract, so now we lose money. Okay, so we have so we get $250 of losses on that contract, but then the December contract again makes money because we were short, and we have a 1 cent decrease here, and again multiplied with the 25,000 pounds, we have a $500 loss gain. Okay, so overall we made 750 by placing a bet on the fact that this shape of the curve would become more normal. Okay, and again, that's something that it's pretty unlikely that these strange shapes. I mean, if we look at the picture, of course, I mean, the strange shape seems to have been there for quite some time. Okay, so for some reason there seems to be a high demand for sugar. Okay, there seems to be a high demand for sugar in what is it, March? In March 23, everybody anticipates a high demand for sugar. Okay, and apparently the same thing is true for March 24. So I don't know what is the sugar production cycle, but there seems to be some seasonality here, and for some reason there is a kink here in the there seems to be a spike in sugar demand in March. I don't know. Easter, I have no idea. I don't. Either a spike in demand, or that's a moment when the sugar production is restarting. So it's an agricultural cycle. So maybe at this point, normally the storage is empty, so we anticipate that the prices go up. But it's surprising. Okay. So that's the calendar spread idea, and you can see how you can combine these positions to, again, I mean, if the prices drop all by 5 cents, so if you have a massive price drop, you don't care. You are totally hedged against the parallel price drops. The only thing that is not supposed to happen here, if the slope goes up and down, you are totally hedged. Okay. If the slope goes up and down, if this one goes down and this one goes up, again, you're hedged. Okay. The only thing that is not supposed to happen is that this kink becomes stronger. Okay. Now, okay, so we already started talking about seasonality, and this is apparently something that happens in the sugar market. Okay. And this is because of harvest cycles. Okay. So this means that the spot prices, okay, vary. Okay. So this is the 10 months spot price for soybeans. Okay. So soybeans are harvested in November. Okay, and as you can see, that means that actually the prices in November or in October, okay, when the harvest arrives to the market, are typically lowest. Okay, and then before the new harvest arrives, the stock is running low. People need to be sure to have soybeans, so they have a high convenience yield. They have to feed their cows, so that means that prices go up. Okay, now okay, and that's the same. So here we have the same pattern for wheat, and we have just seen it for sugar. I mean, it's clearly a seasonal pattern, even if I don't know exactly why it's in sugar and what is the production cycle. Okay, now if the spot price has, in a stylized way, these patterns, okay, so it goes up because the product becomes scarcer and scarcer, and then the harvest arrives, it goes down, and so on. Okay, what should you see? How should the future prices change? The future prices, okay, for the months before the harvest should be higher than the future prices for the harvest months. Okay. And that's probably what's going on here. So I think harvest is probably in October as well. So the future prices for these months before the harvest are higher than the future prices in the harvest months. Okay, which means that the basis, so the difference between the spot and the future prices will actually fluctuate. So you get a basis that depends on the maturity. So you get a basis that goes up and down, and that's again what we've seen here. Okay, and it's related to inventories. Okay, a fluctuating basis often a sign of high risk and unstable prices. Okay, it's a okay, important separate fractional base in the expected unexpected common. Yeah, so I mean that's what we say here. Okay, so clearly there is the prices go up and down, but the basis again remains relatively so it's fluctuating, because the difference between the spot and the futures prices is depends on the maturity, but it remains constant over time. Okay, and that means that, and so this is the impact of this seasonality. So if there is perfect storage, actually this should go away. But apparently in China, no, this is the world. Sorry, no, that's the world sugar. Okay, there is no perfect storage, and that's why we have these price increases ahead of harvest, and this means that you see these cyclical patterns. So this is the so this is the cash wheat price, the same thing. Okay. So this is just okay. Let's move on a little bit because we're out of time. So this is just the same story about storability. So commodities with poor storability and with a production cycle, with a harvesting cycle, this can lead to cyclical price movements, and that's known as the so-called pork cycle. This is, for example, the pork production and the pork prices. Okay, and you can see that there's a clear inverted pattern here. This is the stylized example. So what you get is you get a price decrease. Okay, so let's look at this. You get, so the black line is the price change. Okay, and this is the pork production. Okay, so you get a momentary scarcity of porks, prices go up, and then of course farmers react and start to raise new porks, new pigs. Problem is that these pigs take some time until they arrive at market, because they have to grow, and given that all the farmers start to raise pigs at the same time, looking at these prices, by the time they arrive at the market, you have an oversupply of pigs and prices crash. Then farmers start to take pigs away. Okay, and you have the same cycle that goes on again. Okay, so you can, it's pretty obvious here that you have a very clear negative relationship between the pork production and the prices, because there is this production delay. By the time that the pig producers react to the price, the price has already changed. The thing is that normally this should not happen with futures contracts, because the futures contract here the pig producers are reacting to the current market price. If I don't know how long it takes to raise a pig, probably a year or something. If you raise a pig now and you sell it forward, okay, you should actually see in the futures price that all the other farmers are doing the same thing. So you should see the futures price decrease, okay, and that should be a warning sign to you that actually there is already an oversupply of pigs in 1 year. So if in principle future markets should lead to the disappearance of these cycles, because they should lead to better anticipation of the future demand. Okay, let's move on and let's talk about these inter-commodity spreads. So far we looked at calendar spreads, butterfly, all of these spreads were spreads in the same product in just different times. And then you can place bets on the change in the slope, okay? But another very attractive trading strategy is to place bets on the different price movements across different markets. Okay, so that's the inter-commodity spreads, two different. So so examples are, for example, corn and wheat. Okay, or coal, oil and gas, or Robusta and Arabica coffees. Okay, why are the prices in these facilities, in these commodities, moving in the same direction? But because they are substitutes. Okay, Robusta and Arabica coffee. I mean, that's clear. Starbucks doesn't really tell you what they put in their standard coffee. They substitute one against the other. Coal, oil, and gas. They are all. The price of these commodities depends on the electricity price in the US. If electricity if for example the coal price goes up, okay, then it becomes cheaper to produce electricity with oil or gas, and that means that more demand will increase for oil and gas, and therefore oil and gas will also go up. So we have a co-movement. Corn and wheat, okay, same thing. In the US, it's used a lot for ethanol production. Okay, so they put it in their cars. Pretty debatable whether this is a good idea, but that's what happens. And for cattle feed, so corn and wheat are both used. A large fraction of the corn and the wheat in the US is not used for human consumption, but for fattening cattle. Okay, so you have these substitute relationships that mean that the prices move together, and then you have a production cycle relationships. Okay, and this is the soybean crush, or the energy complex, or the livestock complex. So what does that mean? It means that you have several contracts on soybeans that are related. You have the soybeans as such, and then you have the soy meal, which is produced from the soybeans, and you have the soy oil, which is also produced from the soybeans. Okay, so if you know how much soy oil and how much soy meal you can produce from soybeans, you can try to, and how much it costs to transform soy beans into soy oil and soy meal, you can try to arbitrage this soybeans complex. So if soybeans become more expensive, of course, soy meal and soy oil should also become more expensive. Okay, so let's look at a simple inter-commodity spread. Okay, so this is a situation where a speculator thinks that the prices of wheat, in the future prices of wheat, are too high compared to the future prices of corn. Okay, so again, both are used for feeding cows in the US. So normally, if wheat prices are very high, there should be a higher demand for corn prices, and this should lead to an increase in the corn prices. Okay. Now, what do you do if you think that wheat prices are too high compared to corn prices? May you have long contract in wheat, in short contract in wheat and a long contract in corn. Okay, so that's what we do here: short in wheat, long in corn. Okay, so we buy one contract each, so the prices are different. Okay, 329, 229. Again, 5,000 bushels, remember, in cents per bushel. Okay, now we do this in February. In June, prices have changed. Okay, we enter into offsetting contracts. So we offset our wheat contract, short position in wheat contract, with a long position, 282, and we offset our long contract with a short contract in 229. Okay, what has happened? Now we make losses on corn. Okay, because actually, because what has happened globally? What has happened globally is that both prices have decreased. Okay, both prices have decreased, but actually, as we predicted, wheat prices have decreased by more than the corn prices. Okay, so we didn't place a bet on the fact that prices would go up or down. We just placed a bet on the fact that the relative price difference disappears, and that works out. Okay, so now given that the both prices have disappeared, have decreased, of course our long corn contract has led us to, has generated losses, but our short wheat contract has generated profits that are far higher than these losses, and overall we come out with a winning position, because the relative price changes have adjusted. Now, this is a simple inter-commodity spread, and let's now look at these crush spreads, because these are really the most interesting speculations that you can carry out. Okay, so you have the so-called cattle spread. Okay, so what is the cattle spread? But remember that we have two types of cattle contracts. We have the young cows, and we have that need to be fattened, and we have the old cows, okay, that can be slaughtered. Okay, old. So we have feeder cows, and we have live cows. Okay. Now, of course, we need some food to fatten these feeder cows, but in the US again, they will be mostly fed with corn and soy meal. So for both of these commodities, we have also future prices. Okay, and now we can figure out, okay, what is, I mean, intuitively, if soy meal and corn is very expensive, there should be a big price difference between the feeder cattle, the young ones, and the live cattle, the ones that can be slaughtered. Okay, because it's very expensive to feed them. Okay, and if, for example, if the price difference between the feeder cattle and the live cattle is very low, okay, we can also predict that it probably is going to increase, because if the difference between the live cattle and the feeder cattle and the live cattle is too low, it's not going to be profitable for farmers to fatten new cows. Okay, because they have to buy the live cattle, the feeder cattle, they have to buy the corn, and then they can sell the feeder cattle. Okay, so if the price difference is not large enough, these farmers cannot make a profit, so they will stop buying feeder cattle. And of course, if they stop buying feeder cattle, the price goes down. Okay, they will also stop selling live cattle because they don't produce them anymore. So the slope, the difference between the feeder and the live cattle will go up. Okay, and again, the difference should reflect more or less the cost of soybean and corn that is used to feed these cattle. Okay, so you can see that there is should be a relationship between the input and the output and the production cost. Okay, and if we observe that there are prices that don't correspond to this relationship, but we can place a bet on prices going back to this relationship. Okay, because we know that commercial forces will come in and will bring back the prices towards these relationships. Again, if the slope is very steep, if the feeder cattle are very cheap and the live cattle are very expensive, and if the soy is very cheap, then all the farmers will start buying feeder cattle and feed them. Okay, which means that the feeder cattle price go up, the live cattle price will go up or down, the soy meal contracts will go up. Okay, so we know that the slope is gonna flatten out again. So the same relationships exist for porks. Okay, so you have hog futures. Okay, so that's the smaller pigs, and then you have the pork bellies. That's the output. Okay. And you also have, of course, I don't know what they feed them, probably soy as well. You have feeding. And then you have the soy crush, which is the easiest to understand or to calculate, which is the transformation of soybeans into soy oil and soy meal. Okay. And again, these different commodities are all separately traded as future contracts, and there needs to be, because of these production relationship, there needs to be a price relationship across these different future prices. Okay. Now let's look at the soybeans future market. Okay, so we have three. Let's look at this the soy crush spread. Okay, it's called crush spread because you crush the soybeans to produce meal and oil. So it involves three contracts. Okay, soybeans, soy meal, and soy oil. Okay, so the problem here is to find the right quantities. So soybeans is in bushels as usual. Okay, soy meal is in tons, and soy oil is, one contract is 60,000 pounds. Okay, and the prices are all in different price notations: dollar per bushel, dollar per ton, cents per pound. Okay, now what is the production relationship? The production relationship is that 60-pound bushel of soybeans, okay, one bushel produces 48 pounds of soy meal and 11 pounds of soy oil, okay, and a bit of waste. Okay, now if you calculate how much contracts to how many contracts does this correspond, okay, you will realize that actually, okay, on roughly speaking, okay, 10 soybean contracts, okay, will transform into 12 soy meal contracts and 9 soy oil contracts. Okay, so if you buy soybeans corresponding to the number of 10 contracts, you can produce soy meal corresponding to 12 contracts and soy oil corresponding to 9 contracts. Okay, so you can verify. Using these input and output relationships and using these definitions of each contract, you should be able to verify that this is, okay, roughly how it works. 10 input contracts, 12 output, 12 and 9 output contracts. Okay. Now, so in normal conditions, the value of the meal plus the oil, okay, so the output must exceed the value of the soybeans. Okay, otherwise the crusher, okay, the company that produces the meal and the oil from the beans is not able to make profits. Okay, so normally the crush margin, which is this difference, needs to be positive. It needs to cover the costs of the soybean processing plant. Okay, transportation, energy, whatever. Okay, now the crush spread, okay, is a position where you place a bet on the output versus the input. Okay, so the crush spread is long soybeans, okay, and short soy meal and soy oil. Okay, so you're long in the input and you're short in the output. Okay, so I don't know what's the timing here. Okay, so of course it takes some time for the soybeans to be processed. So you have to take one contract for soybeans and then next contract for the soy meal and soy oil. So the crush spread is this contract. Okay, so you buy soybeans and you sell soy meal and soy oil. Okay, so the crush spread should correspond to the gross profit of the soy meal producer. It should be able, the crush spread should cover his costs. Okay, and the reverse crush spread is of course the position you will enter if you think that the crush spread is too small. Okay, so that's short soybeans, short input and long output. Okay, now let's look at a real life situation. So we have a speculator believes that the crush margin is too large, which means that the output prices are too high to compare to the input prices. Okay, which means that all these soybean crushers, these people that produce soy meal and soy oil, they will start buying soybeans and produce the output. So the margin should go down. Okay, now if you believe that the crush margin is too large, okay, you would believe that the input prices go up and the output prices go down. Okay, so you would have a long position in the soybeans and a short position in the output. Okay, so you would exactly buy the crush spread. Okay, now here's the details. Okay, so here is the soy future prices. Okay, so we have in August, November, and December. We have the beans, we have the meal, and no, wait a second, no. This is the contract. Okay, so we have July beans, and then we have September meal and oil. Okay, so we have we have 3 months of difference. Okay, 2 months of difference between the input and the output, and then here this is the price evolution. So how do we go about this? How do we implement our position? Now, here we start in August 4th, so that's the first date. Okay, we place a bet on our crush spread. So remember, we think that these soy crushers make too much money. Okay, so the crush margin is too high; it has to go down. People will enter the market and crush more, and that's going to lead to price adjustment. So we have to buy the input. So we have 8.66 per bushel. Remember, we buy 10 contracts, okay? And we use these, we know that this corresponds to 12 output contracts. So we have 12 meal contracts and 9 oil contracts, okay? And again, we have these prices. Now, so this is all in the previous year, okay? Because, okay, we look at the futures prices and we think these relationships are not correct. So let's look at what happens in November, okay? So let's suppose we want to get rid of our position by November, before the year, okay? And let's suppose that these are the prices, okay? Now, if these are the prices, we can calculate our losses and gains. There's a strange variable here, but it doesn't matter. Okay, so the bean contract, we were long in beans. The beans went down. Okay, so we were making losses on the beans, and this is a negative sign here. This strange thing here should be a negative sign. I don't know what's okay. I made it worse. Okay. Yes, no, it's here. The strange sign is here. Maybe I can just get rid of it. Okay. Yes. Okay, so we make $40,000 of losses on our bean contracts because we were long and the prices went down. Okay, now hopefully we can offset this with our short position because everything went down. Okay. Everything went down, but actually we can see that our output prices didn't go down a lot. So meal and oil went down. We make some profits, but clearly not enough. Okay, and actually, we have a position. Our speculation went wrong, and we lost $27,000. Okay, this can happen. Okay, now there is a second price range here. Okay, so we can try to wait it out. Okay, we can try to wait it out, but okay, so we do the same thing. Okay, we do the same thing and we wait another 2 months, I guess, now 1 month from November to December, and we realize, okay, it turns out we realize another loss. Okay, so we made a massive misspeculation. So this is just an example to show that things go wrong, and the expression is whipsawed. Okay, because you made one loss and then you made other one right afterwards. Okay, so again, apparently we didn't quite understand what happened to this margin, and there seems to have been a good reason for why this crush margin was so high. So our idea that it was going to go down is apparently wrong. Okay. Now you can do the same thing for the crack spread. So this is the crush spread is soybeans. The crack spread is the same thing with oil and gasoline. Okay, so you have crude oil, it's the import, and then you can have a certain number of outputs. So heating oil and gasoline, and again you have relationships. It's much more complicated because actually in the production can adjust how much gasoline and how much diesel and how much of what kind. To a certain extent you can arrange your outputs, and you can again you get the idea. You can do similar kind of speculations. Okay, so let's stop here for today, and then we start tomorrow with the cattle crush. Okay, so we use real data on the cattle. Here you have, for example, this is how cattle are raised in the US. It's an entire city of cows. Okay, so you can see that there's no grass growing anywhere. So they are all fed by soy meal that's grown in Brazil, and that is bought on the futures market. So tomorrow we try to look at whether we can make money at the moment with the cattle spread. Okay, and then we move on to the last topic we still haven't covered is how do we invest in commodities. Okay, so I have a question here, but again, please ask these questions. You can see that I cannot see the. I love to have questions, but if you don't raise your hand or you don't speak, I cannot see them. So what's the question? What's the purpose of buying 2 September in November to 10 balance? Yes, indeed. So we have 2 short positions, so we need 2 long positions to offset them. Otherwise, we will have an outright position. And an outright position is extremely expensive in terms of margin. So we have to invest a lot of margin. Okay, and it's also very risky for the trader. So as I said, very rarely do the financial investors take outright positions. They are just too risky. The hedgers, they take outright positions because they need to hedge their supply or their demand, but not the financial trader. Okay, so thanks a lot for listening, or not. No, I think you're listening, at least the ones who are still there. And tomorrow we try to evaluate. We try to evaluate whether you can make money from theoretically raising cattle in the financial markets. Okay, see you tomorrow. Bye bye.
Chị hãy thương quản lý các